Kotak Mahindra Bank had a decent quarter with no overt disappointment. Although the business growth was quite lackluster, perhaps a warranted caution in the troubled times. In our Ideas for Profit today, we'll discuss what should investors do post the Q2 earnings. Well, the core performance was steady this time, and the pre-provision profit growth of 31% was seen, which was supported by net interest income growth as well. Margins saw a sequential improvement to 4.52% as well this time. A tight leash on the costs also helped it, lowering the cost to income ratio to 38.5% from 45% in the year ago quarter. Also, the after-tax profit growth would have been much better had it not been for the much lower tax in the year-ago period. Now, the asset quality picture did not show much of a change, and that was thanks to the Supreme Court really ruling that barred the banks from recognizing NPAs even after August when the moratorium period ended. Also, there was negligible reported slippage in this quarter under review. However, as a prudent measure, the bank has already disclosed that had it recognized the slippages, its gross and net NPA would have been 2.7% and 0.74% respectively. Now, the bank has also provided 92 crore rupees for the same. Now, the bank has now got a provision cover of say over 75%, and that's against its recognized NPA. In addition, it also carries COVID provision to the tune of 1279 crore rupees. We do not see the bank requiring to make substantial provision in the quarters as well. Now, the bank had been cautious about growing its loan book, and in the recent quarters, as part of its conscious strategy as well, it had degrown the unsecured retail growth, which was the driver solely, which was driven solely by the secured assets like home loan, tractor financing, etc. However, the bank is now repositioning its strategy in favor of growth and also of customer acquisition. Now, after having built a robust liability, the strategy is going to be driven by capturing customers by offering variety of lending products and also eventually garnering the customer deposits as well. Now, thanks to the recent capital raising of say about 7,442 crore rupees in the recent times, that has taken the capital adequacy ratio to 23.4% with a tier 1 at 22.8%. It is in a position to grab the market share. Now, the share of stable granular deposits is also close to 91%, and the strength of the liability is empowering the bank to now push the growth pedal, as it can still build a high quality book amid challenging macro, and that's thanks to the competitive cost of the funds as well. Finally, the strength of the conglomerate with promising businesses that is across the financial services space puts the bank in a vantage position, as it stands to gain significantly from the financialization of savings as well. Now, the current pandemic will have many casualties in the financial sector, and the waning competition from say NBFCs as well as the weaker banks also puts Kotak Bank in a vantage position. Now, while the valuation at 3 times FY22 estimated core banking book actually looks optically quite expensive, investors must also factor in the immense value unlocking opportunity that in the various promising subsidiaries of the bank, which is none of them are listed at this point in time. So, for many years now, investors had been waiting to see a comeback of growth in this bank with a promise to deliver the same as well. The stock is currently set to outperform in the coming years as a winner out of the pandemic.